Welcome to Stock Market Today. I'm Nate, and with me is Nick, our tech sector specialist. Nick, big week already, and let's jump in.
Thanks, Nate. Plenty to unpack. The headline I'm watching is xAI reportedly pulling in about $20 billion in new funding. That's a huge signal for the whole media and communications space.
$20 billion. That's massive. Help our listeners who invest but might not live in the headlines. Why does that matter beyond the flashy number?
Two ways to look at it. First, who is investing matters. Reports name Nvidia and Cisco among the backers, plus Gulf backed funds. That ties the companies that build AI, compute, and networking directly to a platform that could distribute AI driven content and services. Second, it shifts competitive dynamics. It's not just another startup round, it's strategic capital that can fund large scale model training, data deals, and integrations into social and media platforms.
So, for investors, should they be chasing the platform or the suppliers like NVIDIA and Cisco?
Both deserve attention but differently. Platform outcomes depend on governance, monetization plans, and user adoption. Things we'll only learn when XI and its backers disclose terms. Suppliers, though, are more directly exposed to increased demand for chips and networking equipment if XAI scales model training and delivery. If you want exposure with clearer hardware demand math, look at compute and infrastructure suppliers. If you want platform upside, be prepared for more volatility and execution risk.
Got it. What are the near term things investors should watch for from xAI?
Watch for official disclosures on governance, board seats, and planned uses of the money. Any mention of content monetization, advertising integration, or exclusive distribution deals could move stocks tied to content and ads. Also, keep an eye on whether infrastructure vendors announce partnerships or preferred supplier arrangements.
Switching gears to media, Amazon's MGM hired Jen Levy to run unscripted TV, and Netflix scored big with the final season of a hit show. What's the investor angle there?
Amazon hiring Jen Levy signals a real push into unscripted, think reality, docu-series, and other formats that can be produced at scale and monetized through ads, sponsorships, or licensing windows. Unscripted is cheaper per hour than big dramas, but can still draw big audiences and recurring viewers. Meanwhile, Netflix saw roughly 106 million views for the latest season of that franchise, which underscores how tentpole shows can drive subscriber engagement and retention.
So, are investors better off backing the platform with the hit shows or the studios that make the content?
It's a mix. Platforms with hit franchises get subscriber stickiness and pricing power. Studios and producers can capture value through licensing, sales to multiple windows, and format exports. For investors, look for signs of scalable monetization, exclusive windows, ad deals tied to unscripted or licensing playlists that suggest multiple revenue streams.
On the broadcast side, we heard late night shows trimming music performances. That seems smaller, but is it meaningful?
It matters because it reflects cost discipline and changing programming priorities. Cutting music slots affects music labels, promoters, and brands that sponsor those segments. It also signals that even established formats are re-evaluating what drives ratings, which can shift ad dollars and promotional strategies.
Let's talk telecom. AT&T is sponsoring free satellite Wi-Fi for A Advantage members on American Airlines for about 2 million flights. What's the strategy there?
This is a practical commercial move. Carrier-sponsored connectivity, where a telecom sponsors or pays for access on another carrier's network, is about retention and sponsorship revenue, not just raw data sales. It gives AT&T visibility and brand value with frequent flyers, while American Airlines benefits from a connectivity upgrade without direct customer charges. Analysts will watch take rates, sponsorship revenue, and whether customers respond with higher loyalty or spend.
And there's also chatter about 6G, some debate about the business case. Should investors care now?
6G is mostly a long-term research story. Some telecom firms are investing in R&D, others question near-term returns. The nearer-term impact comes from capex guidance and vendor roadmaps. If equipment makers start flagging big 6G era development costs, or if carriers shift capital away from current networks, that could ripple through supplier revenues. For now, watch conference commentary and any changes to capital spending plans.
Before we wrap, what are the practical, immediate things investors should monitor this week or quarter?
Shortlist 1. Official disclosures from xAI and any partner statements that reveal governance or commercial plans. 2. Amazon announcements about unscripted slates or licensing tied to the new hire. 3. weekly engagement and viewership metrics from Netflix to see if the franchise momentum sustains. 4. KPI updates from the AT&T American Airlines sponsorship, take rates and customer feedback. And telecom conference updates about CapEx and 6G roadmaps.
Great. Let's finish with two quick takeaways for listeners.
Number one, xAI's roughly $20 billion raise makes AI platform strategies central to media. Watch suppliers of compute and networking for more predictable upside. Number two, content is still king. Big franchises and scalable unscripted formats drive monetization in different ways, so follow both platform metrics and studio licensing activity closely.
Perfect. Thanks, Nick. That was Nick breaking down the headlines and what they mean for investors. I'm Nate. Thanks for tuning in to Stock Market today.